everybody. Welcome to Friday, another Talk Money with Tom show. Really excited to have you here today. We're going to try to help you improve your success rates in your retirement. We speak about asset management, retirement planning, and of course tax planning. Those are big areas. We really feel like, the more that you know, the better you can do in your retirement, whether it's, happening sometime in the future or you're currently retired. Still, I think a lot of the educational aspects are important here. And it's very difficult, in my opinion, to find some of this information. That's why we started this channel. So we do have 900 videos on the channel. You can peruse at your own speed and what have you. You can also subscribe to the channel, hit the little bell next to it. You'll get notified when we put new content out. Again, the more you know, at least financially, I think the better your retirement can be. And it's such a wonderful period of life if it's handled properly. So, of course, the next thing that we try to do here is, we can meet with people individually. So you can go to our website. There's a link here on the channel, and just go hit the book appointment button and go, set up a 30-minute video phone time with Eason and I, and we can maybe help you kind of on a custom basis. So hope there's something that happens here. In terms of the questions, they can be sent in to asktom@talkmoneywithtom.com. Anytime during the week, you can send them now. Also during the show, we'll try to answer them live, and you can put that question into the chat box if you'd like to. So really, please send them in as you think of things. This is a great chance for you to get some of your questions answered. So look forward to kind of hoping get one or two that really make sense to you that might help you as far as that goes. Of course, I do like to start off the show each week with a summary of what I saw happening in the market. And I'm also going to answer a question right now, too, that I've been getting from clients in some of the strategy sessions that I have, which is just essentially, the market is down. We have gotten defensive and reduced our stock market exposure over the last 5 weeks. And really, the question is, why are we doing that? The market is down. Isn't it time to kind of hang in there and let things, develop? And of course, now we've had a great week this week in terms of the upturn as far as that goes. So I'll show you some of the things that I'm seeing and historically what that means and what's happened in the past when these things have happened, and kind of why we're having caution here, and kind of share with you some of those pieces. So of course, we start with the market itself, and we look at what's happened so far this year. So you can see, obviously, we've had this downturn. Blue line is the 200-day moving average. It's also coming down. But if you look at this last week here, we had a nice run-up, and except for today. Right? So Snap reported earnings last night. They're getting really hit really hard, and it seems to have affected the market overall. What has happened in these earnings periods for 2020, 2021, we've seen earnings be a catalyst to the upside, mainly because the analysts have chronically underestimated how much impact all of the stimulus would have and how much that would impact earnings to the upside. Well, what we've seen last quarter and what we might be seeing this quarter is that the analysts are actually overestimating what's happening. And so as these companies come in, they start missing their numbers, and we can see the stock market kind of come down. That's certainly what happened with Snap, and that makes the stock market worry about what might be happening with Google or Meta, because they're both in that kind of online advertising space, for example. So we also had some interesting things to the upside here. There's a couple of gaps that were established on the way down in the middle of June there that you can see. The market has a really high propensity to refill gaps. So we refilled the lower one some time ago, and today we basically refilled almost exactly the gap that happened earlier in the middle of June. So, lots of resistance above here. I still think we have a little bit of room to run upward. Wouldn't be surprised. Next week is kind of a big week with all the big tech companies reporting. Plus, the Federal Reserve will be doing their meetings and coming out and telling us, what they're going to do with the interest rates. I wouldn't be surprised to see that that's a positive catalyst. Yet we're still being defensive, right? And so let me talk about why. All right. So first of all, the leading economic indicator was reported for June on Thursday. And so that's the blue line here. These big gray bars that you see, those are the recessions that have happened. This is going back to 2000. And you can see the most current blue line there is certainly peaked. It dropped 0.8% in June is now 2% off of its top. And this indicator is a basket of 10 different indicators that's been very successful at predicting future recessions. So when it peaks, you got to be careful because a recession combined with a bad stock market can really create some problems. The gray line there is the actual current, what they call coincident economic indicators. And what these are showing is kind of what the economy is doing now. And so this is where it gets confusing for the clients, right? Hey, the market's coming up this week. Plus, we're starting to see, the economy's still doing okay. You can see it, it's going up in the gray line there, right? But if you look closely at this, the blue line peaks before the gray line does. And that's why they're called leading economic indicators. And a lot of people get lost in all of these different news reports as to which ones are leading and which ones are current and even which ones are lagging. So current and lagging aren't that critical for the stock market. It's always looking forward. But one of the key things is if you go back long term, back to 1960, and you take a look at the S&P 500, and you look for periods of time where the S&P 500 is below the 200-day moving average, which is that blue line, right? And the blue line, 200-day moving average is moving down, and the leading economic indicator is peaked. That's a very rare occurrence, and when it has happened, we've had some very big downturns. So this is the main reason that we started to get conservative in the middle of June, because this was reported for May in the middle of June, and it certainly showed some peaking, and it was even further emphasized this month when it dropped 0.8%, which is a lot for this particular indicator. If you look long term, you can see going back to 1960, the gray bars are recessions. And you can see it's pretty consistent at peaking out before those recessions. That's why I like it. Doesn't always work. It probably won't always work. It could be that we set a bottom back in June, but when you look at all of the different pieces that are going into what's happening, it is, in my opinion, a time to be conservative. We still have exposure to the stock market. We will still go up if the market goes up like we did this week. We will still go down if the market goes down, but just not as much on either side because we have a lot of T-bills now that we've purchased, T-bill ETFs, and we also have some inverse, S&P 500 inverse that goes the opposite direction in order to kind of insulate our clients from some of the volatility that might be coming our way as far as that goes. So here's some of the things that I'm looking at. First of all, here's the good news. In a way, depends on how you look at this, but consumers are purchasing. So this is manufacturing's new orders for consumer goods. It's up in June. That's good. Consumer retail sales up in June. That's good. But there's a couple of problems with this that we have to watch out for. Number one of the reasons that retail sales is up is because things cost more, because it's purely just a dollar amount. It shows how much is being spent. If we take out the rate of inflation, what they call real retail sales, it's actually coming down. And so what's happening there is essentially, let's say last June, we compare the retail sales this June, it's up 8%. That's pretty good. But if inflation's up 9%, actually the real retail sales drop 1%. So part of what's happening here in terms of that number is it's being driven by this, inflationary environment that we're in. Things just cost more. But one of the real issues is the consumer can save us from a recession if they keep spending and keep spending and keep pushing. And because the Federal Reserve will have that room then to lower, to slow down the economy with this rate increases. The problem is 2/3 of the economy is consumer spending. They're going to be fighting each other. Consumers going to come in with all this pent-up demand and want to travel, want to spend money, go to restaurants, go to movies, do these things we haven't been able to do. And the Federal Reserve is going to be on the other side really, really fighting this inflationary environment. And what's going to happen, you're going to have a battle, and that's what's happening now, between the consumer and the Federal Reserve. The Federal Reserve will win that battle in the end because they'll keep pushing and pushing and pushing. And then when the consumer capitulates, you could get a much bigger downturn because the consumer pushed off. There is one path where they capitulate just enough. and the rates are raised just enough, and we get what's called a soft landing, and we end up with a market that does pretty well in that environment. So we'll see what happens here, but that's the battle that is intensifying, and that's one of the things that I'm concerned with. And then if you look at what consumers think about their current situation, their expectations. So this is a survey, University of Michigan survey, that's done that shows, basically asks the question, what do you think of your finances in the next 6 months? And it's down at nearly a record low going back to 1960, actually 1950s. And so, they're spending, right? Credit issuance is going up, right? Credit card issuance is going up. People are, there's a lot of pent-up demand, and we expected this. But it's creating this giant inflation, and there's creating situations like what happened in Ukraine, obviously, where gas prices are very high. And so people are looking at that inflationary environment and feeling negative, right? This particular index is in the leading economic indexes, the 10, because it is seen as a future gauge of future economic activity. Okay, current retail sales is not in the leading economic indicators. Manufacturing orders are, because that's earlier in the process, which I'll show you that in a moment. But this survey has predictive power. So the consumer is saying, I feel negative. Eventually that starts to possibly affect their spending, right? So we have to watch out for that again because it's a big component. Then if we look at what's called the yield curve, right? So, normally the yield curve is, your 3-month T-bills pay a lot less than your 2 years, which pay less than your 5, which pay less than your 10, et cetera, and you get this yield curve. Right now, the 2-year is paying more than the 10-year. They call that an inverted yield curve. And so you can see the difference graphed out on this graph here. And when it gets below 0, like it did before 2000 and before 2008, that was a precursor warning to a recession. And so this has been one of the more accurate predictors of recession as far as that goes. Although I think the more accurate predictor, according to the study that the New York Fed did, is really the 3-month, right? So think about that. You could make more at periods of time, and this happened back in 2000, before 2008 downturn, before the 2000 downturn. The 3-month T-bill was paying more than the 10-year. So you could invest money into a treasury and make more money in 90 days than you could by letting them hold on to it for 10 years. Why does that happen? That's because the bond market is a very good predictor of future economic weakness. And so they see in 10 years or in that longer period of time, the economy might be doing poorly. So that has not crossed. That's not negative right now. But the trend is drastic, right? I mean, since March, it is coming down. It looks like it's heading towards. I mean, if you look back on this chart, just for this time period, the only times it's had that type of downturn that fast, it has eventually turned into a negative, right? So, we'll see how this plays out. But again, the direction is worrisome as far as that goes. And we look at, U.S. Manufacturing new orders in total down, right? You can see that, right? So manufacturing, this is one of the leading economic indicators for a reason, right? So you focus on things that are leading the economy, and these will also be things that will lead the stock market, theoretically, as far as that goes too. So here's average weekly hours worked in manufacturing, peaked out in March, coming down. Here's building permits. So building is, residential building and what have you, and that's what this is, new residential units, is huge industry, massive, and we're starting to see, that peaked out in January. So again, that's a leading indicator. It's not, houses that sold, those were built a long time ago, basically. It is new permits for new homes, which is starting to fall. Obviously, mortgage rates are up to 5.8%. They were at 3%, just beginning of this year. That's going to slow down housing. That's going to take that entire industry of mortgage brokers and realtors and contractors, and all of the different people that feed into that, interior designers, and put a crimp potentially in their, overall revenues, which eventually will flood through the rest of the economy. This is actually a lagging indicator, and that's the claims for unemployment insurance. I just show it to you because it is up 50% from its low. You can see that little dip there in April, and it's come up. And so still quite low. and the market for employment is still quite good. Still a lot of job openings, but it's starting to deteriorate. Again, that is a lagging indicator. Employment lags the economy. It lags the stock market. That's for sure. But nonetheless, something interesting. And the last piece I'll show you is just gas prices. And there's some good news in here. First of all, you can see it peaked at $5 nationally, not here in San Jose, but nationally, and it's at $4.50 nationally. That's a big drop, actually. And here we are in the summer, which is kind of a peak driving month, and gas prices coming down. That's cool. If you look at the wholesale futures right now, it's predicting a $4 gas by the end of the summer for national. So again, that's a good thing. But the problem is, if you look at that chart in totality, it's still up a lot, and it's a huge, draw against the economy, because gas and diesel, for example, are used in so many production capabilities, transportation, and of course, as consumers, if we're spending more money at the gas station, we're not spending as much money in other areas. So this is a good thing. But it's very, very important to watch this, especially because of what's happening in Russia, Ukraine, where they can kind of weaponize the energy, which they've started to do with natural gas. This is gasoline, different substance, but they've started to really weaponize natural gas through this Nord 1, pipeline. They've only got about 40% of the flow coming through, and kind of pinching, Europe in that regards. And so, anyway, this is probably one of the most important things to watch as far as that goes. So, in summary, I love the fact that the market is coming up here. I'd love to be, back in the market wholeheartedly if it continued to come up and continued to really gain and break through some of these barriers. We are heading towards some very big resistance. I wouldn't be surprised to see us get up higher next week, hit that resistance. But I'd be a little bit surprised to see us break through that with all of these other negatives that are happening out there. It is possible. So you have to watch for this. You can have a thought for where things are going to go, but you have to be able to be flexible in that thought process. But at the moment, when I look at that leading economic indicator peaking out, and I look at what happens, like the average downturn since World War II for the stock market is 15%, but the average downturn with a recession since World War II for the stock market is negative 36%. We're down about 17% right now. That's a big jump down to get to the average if it should happen. And these things happen exactly like this, where it's this, I call it a rolling downturn, and kind of, it goes up, and like we saw in late March, and then it comes back down, and it rolls up, it looks good. And so 2008 and 2000 are the last two rolling downturns we had, which were negative 45 and negative 57. This is not a V downturn like we saw in 2020, big downturn, very quick recovery. And what we saw in 2018, again, big downturn quickly, very quick recovery. Both of those had the Federal Reserve lowering rates to create that, had Congress putting out stimulus. We're not going to see any stimulus right now because of the inflation. And we are going to see the Federal Reserve continue to raise rates dramatically, trying to fight the inflationary issue, even if it means causing a big recession and additional pain to the stock market. So again, it's just a time to be careful. I wouldn't be worried about things. We've already taken care of that for our clients, and we've lowered the exposure. We'll lower it farther if we have a lot of downturn coming at us, and really try to protect the asset base. And then it gives us power to come back in at some point if it does come down. We got these T-bill ETFs. We can come back in and be buying things at a lower place and really take advantage of this if it does happen. So we'll see what happens. I'm just showing you kind of historically what's happened and what's happening right now in the leading indicators, not the lagging or current indicators. And those are the things that I look at that, let me feel that we're on the right path. Okay, so anyway, I appreciate you listening to me this week. Look forward to talking to you again next week. All right. What do we have for questions today, Ethan?
So I feel I missed my window to sell my house at the peak and move. Should I wait until rates go back up, or rates come back down and housing prices come back up? Or does this even matter? Am I trying to really min-max in a situation where I don't need to?
Yeah, this is questions that have come up in our client strategy sessions. People that had thought about the possibility of selling and moving out of the area, moving to someplace cheaper for their retirement possibly, or during their retirement, or whatever the scenario is. And, let's face it, who gets the peak, right? And who actually sold their house at the peak? Some of those people were pretty smart, but most of them were probably just pretty lucky. It's just kind of how it works. And so I think you have to resign yourself to the fact that you're not going to get the peak. You'll sell, and you'll look back, and your friends will be telling you how much their house is worth now. You think, oh man, I wish I would have waited. Or you'll find the market starting to soften, and you'll wish, oh, I should have sold before. That's the chance of that happening is actually really, really high. Right? I mean, the chances of you being totally satisfied at the peak. So part of that is just sort of a mental adjustment to reality as far as that goes. But the rest, honestly, right now, if you look very closely at what's happening with homes, the actual price of homes nationally, at least, has continued to actually go up and hold. What is happening is that we're seeing longer term. You're not getting, 8 hours later, you got 25 bids, all massively over, current price and that kind of thing. So that has slowed down. So I think, right now, it's still not a bad time to sell. I don't think that's a big issue. It does matter kind of where you are in the market. One of my clients is actually, she markets for a big home builder, and they're a luxury home builder, but they've kind of spread out their packages to include condos, and they're seeing condo sales kind of have more trouble than their big $3-4 million houses. Because, again, probably that group that's coming in to try to buy something less expensive is going to be more impacted by the increase in mortgages than possibly the group that's up in the upper end. Maybe they're selling another house, so they got enough money to make it work, or they have stock options, or whatever that might be. So again, it depends on what type of house you have, as to and exactly where you are and what market as far as that goes. But I wouldn't worry about it. If I needed to sell or wanted to sell, I'd sell right now without any problems. If I had some flexibility, I might wait. But the problem with waiting is you could be waiting for a decade to get back to this price. You have to be really aware. I mean, what the question was, should I wait for rates to drop? And, basically then maybe the price comes back up, right? Wow. I mean, if you could tell that, I wouldn't be playing that game at all. No way. I'd take what I have now if I needed to and not worry about it, and just, understand that I was probably never getting the peak anyway, right? I mean, because there's probably more risk that you'd be wrong there, and that prices go down and down. You're waiting forever to try to get back to what you could have done today, right? Take what you have today if that's the option.
Yeah, and a lot of people are trying to look for that perfect ideal exit case. But, sometimes we have to settle for good enough. And, we don't always have to go for that perfect. Because when you think about it, if, I'm selling at this price, and, it's come down a little bit, maybe where I'm buying now is going to also be coming down in parallel. So, there's also, when you buy, you also want the price to be coming down too, right?
Yeah, that's a good point, actually, because you might be selling in this area. If you're selling in this area, the demand is still pretty good. There's still stock options. People are hating the traffic, so they're willing to pay, a premium to be closer to work. A lot of the work is in same places, that kind of stuff. So, and you might be moving to another place that doesn't have that kind of employment dynamic, and they could be falling more than yours is. Maybe you're down 3% from the high, and they're down 7%, right? So you're exactly right. It's not just your house. You're going to, theoretically, I would assume, buy something else, right? So yeah, that's a good point too. Is, sometimes that can work out to your advantage. Especially if you're a lot of our clients have sold homes because of retirement. They're in retirement or heading into retirement, and they've cashed out the values of their homes. And again, it depends on, I don't know where this person lives, where everybody lives that might ask this question, but in our area here, pretty good chance, even though it's off the high, you've made some money.
Yep.
Right? Because the price of houses did so well here. So, take that and be happy with that, right? So it's a good question. I think it's really interesting. There's a long ways to go in this particular arena here with the housing. It's going to be fascinating.
So our next question is, what is a benchmark? What are some of the big standard ones, and how do I make sure I'm using the right benchmark for my investments to evaluate its performance?
Yeah, so that's, what is a stock or bond market benchmark? It basically comes up quite often. The one that I talk about on my show that I just covered with the weekly summary is the S&P 500. I feel like if I have to follow one index that everybody seems to know about, that's the one I'd follow. It's 500 stocks. They're curated by Standard and Poor's, basically. So they have to have some earnings, and they have different criteria, and so they've kind of like a quality screen to get on there. But it's fairly representative of the overall market, right? Because it's big enough, and it's market cap weighted. So the big companies are going to have a bigger impact. Sometimes that's not always a good thing, but versus the Dow, which is the one that I hear about the most. I mean, I don't follow it, honestly, because it's 30 stocks. I do follow it a little, obviously, but it's 30 stocks instead of 500. But it has a really weird scenario because it started in 1883. It's actually price weighted. It's weighted by the price. So a stock that has a higher price will have more impact on the Dow. And I don't know what price has to do with anything, because now you can split and all these things. Matter of fact, I just saw a thing saying that Google and Amazon now have a chance to get on the Dow because they're splitting and because their prices come down, whereas before they couldn't get on the Dow because they would have dominated the Dow. They were so expensive, $2,000-$3,000 per share. So that doesn't make any sense to me. I don't know. It's an interesting index. And then the next one, of course, is the Nasdaq, which is a good index and has been a great index to follow for periods of time. It's 1,000 stocks, and it's mostly technology oriented, right? So that's where you'll see kind of these tech stocks live. You can kind of tell what's happening in the growth stock arena by looking at what's happening with the Nasdaq. And of course, we got the Russell 2000, which is, they have the Russell 3000, which is like most of the stocks on the entire market. That one most people don't know about. The Russell 1000, which is the bigger stocks. Again, that's not one people know that much about. The Russell 2000 is kind of that bottom two-thirds. It's 2,000 stocks. And so if you're looking for what's happening with small cap stocks that day, that's what you'd be looking at, in my opinion. Those are the four biggies. They're right there on Yahoo Finance every day, 1, 2, 3, 4, right? Just in that exact order. Now, if you really want to do what we're doing in terms of benchmarking, in my opinion, you go to Vanguard and you use their existing mutual funds or ETFs as your benchmark, because Vanguard does an incredible job of including so many securities, large cap, mid cap, small cap, micro cap, which is not included in many. And so the Vanguard Total Stock Market Index is a U.S. index, right? And it has 4,136 stocks on it now. That changes all the time, but something around that number. And it's the most broad index. It's what we benchmark our U.S. holdings against, right? And then Vanguard also has a total international stock market index, which is very good at replicating the entire international arena, emerging markets, developed markets, all of it. And so that's how we benchmark any international holdings that we have in the stock market. And then if we have some that are kind of a mix of U.S. and international, that Vanguard has a total world, right, which is the combination of both the total U.S. and the total international, right? So those are three for the stock market. That's what we use. That's how we benchmark. Our clients have access to a portal where we use those as our benchmarks. And the reason I always use those is because anybody can go buy those. You can't actually buy the S&P 500. You can buy a replica of it, and that type of thing. So you can go buy Vanguard for very inexpensive, and don't have to pay somebody like us. So we're trying to show, did we create value in our management or not after our fees and all those different types? Did we beat the Vanguard or did we not? So, and then of course, just very quickly, there's a total bond market index, BND, which is the ticker symbol for the ETF, is a very good representation of the U.S. bond market. Total international bond market would be for international bonds, and then total world, right? So there's 6. World stock, U.S. stock, international stock, world bond, international bond, and U.S. bond, right? So those 6 can really round out your benchmarking. If you really want to see how you're doing, then use those indexes, in my opinion. I talk about the S&P 500 because that's what people know about, right? Of the four biggies, it's the one that makes the most sense to look at.
Yeah, and whenever you're evaluating performance, you also don't want to just check one period. You want to be checking, how are they doing the last couple months, how are they doing the last year, how are they doing the last 3 to 5 years? Because, maybe a stock is hot right now or it's cold, but maybe its overall performance for the last 3 years has been really good.
Yeah. Yeah, I was just looking at a client's account the other day, and he was an early investor in Facebook, now called Meta. And Facebook has had a really hard time here in the last 12 months, right? I mean, really unbelievably underperforming, say, VTI, the total stock market index with Vanguard. Yet if you back that up at just to 3 or 5 years, he has a fantastic rate of return versus the overall stock market. So, yeah, perspective on time periods is still pretty important to take a look at, and that's a good point. Yeah.
So this is a market-related question. Is it time to cut back on expenses with the market being down and inflation rising?
Yep. Good question. We're getting this question often right now from our clients. We have some pretty smart clients, and they really kind of understand, what is happening here. And we've talked about this with them extensively. So here's how I would look at that, and really kind of almost a formula for how you might determine whether you should be doing this. Take a look at all the resources that you have that are in kind of the cash, savings, checkings, how much money is in money markets. So we have investment accounts, and we keep some money in money markets that we withdraw from for the monthly distributions that people take out to live off of and such. So you add all that up, all right, whatever that dollar amount is, and then say to yourself, and everybody's kind of asking me for a rule of thumb for how much cash I should have. And I can tell you, after doing this for over 35 years, there is no rule of thumb that works for everybody. That's true anyway, all this stuff. That's kind of a frustrating thing in our business, all these rules of thumb. I hardly ever see them applied, for a couple people maybe. And so the one that really works is to take a look, and let's say I have $100,000, and I'd say to myself, okay, what if that was 50,000? Would I still feel like I have enough cash if I needed it? Or what if that was 25? At some point, I'm going to get to a number that I can feel it, right? Almost like makes my heart race a little bit. No, that's too low. So let's just say it's 50,000. Okay, so I've got 100 all together, adding up everything. I've got, $50,000 I could go down to. So I could live off of that cash for that 50,000. So how much am I taking out on average? Okay, let's just say it's $1,000, right? So that I got to think about that. Okay, so if it's $1,000, that's 50 months. We're working towards 5 years. Is the market going to be higher in 5 years than now? Historically, on average, the answer would be yes, on average. Can be lower. Mm-hmm. And so I don't know that I'd make an adjustment. I'd keep spending that 1,000 because I've got so much time before I have to start selling stock or bond to replenish that cash, right? Let's say, though, that I'm taking out 10,000 just to make up a number, right? Now I got 5 months before I'm going to be required to go sell some stock and bond in some of my portfolios to replenish that cash. Could the market be lower in 5 months? Yes. Could be higher, but it could definitely be lower. So now I have to say to myself, okay, I need to maybe cut back if I can. Can I get that down to 8,000? Is there something I can do to reduce that? Because I'm heading into a down market, I'm pulling out so much that it's going to require me to sell stock and bond at a possibly a lower point. And if I can reduce that in some form or fashion, you should. Yeah? Yep. So that's it. I know it seems a little complicated, but that's the answer. It's how we answer it. It's how we go through with the clients. I get somebody call up and, hey, should we be cutting back? I do the little calculations. I said, look, you have, 29 months worth of money at current, and we gathered extra cash at the very beginning of the year. That turned out to be a really good idea. And so, you have 29 months worth. All right, I'd keep going with what you have for now. When that gets down, maybe half of that, we'll start talking again. Maybe you do have to start cutting back if the market is still down and hasn't recovered, right? So, it depends, right? It depends on each situation. But it's a really good question. You can figure it out. It's not rocket science. It's possible.
Yeah, and maybe it is just time to check your budget. There's always fat in our budgets, and maybe I have an extra streaming subscription that I don't use anymore, and I've primarily switched over to another platform. Do I need to be spending that money every month? No. And small things like that, you can check, maybe a magazine subscription that you don't read anymore, stuff like that, that's super easy to cut off.
Yep.
Yeah, just go ahead and that. And also, maybe it's not time to, book a very high-end vacation or big remodel project. And so maybe you keep what the status quo is, but you just don't take on any big expenses.
Yeah, I think what you're talking about is what I talk about. Is it time to cut back on my standard of living?
Mm-hmm.
And so if I'm not watching that streaming service and I'm paying for it, that's not cutting back on my standard of living by going through and spending some time and finding those things. If I'm not reading that magazine subscription and I'm still paying for it, right? Now, big trip versus little trip. I don't know. Personally, when things get tight, I'm more satisfied with the littler cost trip because it makes me feel good. Going on that big expensive trip when I'm worried about my finances actually detracts from the trip, right? Remodel versus not remodel. That gets into some weird areas because there can be some real problems with your house. This bathroom doesn't work at all, So, but many times those can be delayed too. And maybe if you delay and things do fall apart, you might be able to do it for cheaper at some point in the future too, or at least even find a contractor who'll talk to you, which would be nice. That's how I would look at it. It's a really good question, should you be reducing your standard of living in that scenario where you had 50,000, you're taking 10,000 a month, and you only got 5 months before? The answer is yes.
Mm-hmm.
Yes. Yeah. In that scenario where you're only taking 1,000 out and you got 50 months, the answer would be no. I'd still be doing what Easton says and looking for things and cutting back. I mean, that's something you should do all the time, but certainly not a bad thing now. Maybe I'd be delaying some remodels and big expensive trips too, as far as that goes, but just because it makes me feel better about my overall situation. But should you be reducing your standard of living or not? We all a lot of people ended up reducing standard of living during the 2008 downturn, right? Because it was so big, and it wasn't just you, everybody was in the same boat. We're all doing it and such too. And so, that's kind of what we have to be asking ourselves right now as we go through this particular process. That leading economic indicator curling over and being 2% off of its high is a really big deal to me. I've been studying that index for a really long time. And personally, from a business standpoint, from a personal standpoint, I pay attention to that. When that keels over, I'm going to start to, reduce things and cut fat and do things that I don't really need right now. So I would consider that as part of this process, as far as that goes.
So our next question is, I just got laid off, and what should I do? What is my checklist? What should I be getting prepared for? What should I be looking at? There's so many things to think about when you get laid off.
Yeah, we saw in the summary for the market that I just presented that first time initial unemployment claims is up 50% from the low that it hit back in April. And so this is happening more and more. 255,000 people last week applied for, first initial unemployment. And I've had a couple conversations with clients who've been laid off. Here in the tech business, we're seeing some layoffs and slowdowns and different things along those lines. So what do you do? What's some of the things that you should think about, correct? And there's lots of different pieces that are out there. I'll try to focus more or less on some of the financial ones as far as that goes. I think one of the first things I do is to really take inventory. What do I have, right? What assets do I have? Where are they? Am I aggressively invested? More so than I should be because I used to have an income and now I don't, at least temporarily. Should I be a little bit more conservatively invested to just make sure I maintain principal? Because the double whammy of a layoff combined with having your assets fall dramatically would be really painful. I would probably try to avoid some of that. Um, and and so you had a whole bunch of things when we were talking about this before too that I think were really useful.
Yeah, so you want to figure out if you're a dual income household, how much of your pay is kind of disappeared. Is it only half? Then maybe you can figure out, okay, my insurance is okay if I just go through my partner's insurance. I don't need to do Cobra. So you have to think about what is my insurance needs now? Do I have it? If I'm the only one providing the health insurance, I have to do Cobra. What is that going to do? Because my employer is not subsidizing anymore. How much more is that going to cost me? Next is, do I have any outstanding debts, like a student loan, where I could go into forbearance, for 6 months, where I don't have to make that monthly payment, even though student loans right now are zero because if you're for a federal loan at least. But you can postpone them for 6 months, and there'd be a kind of like just an accrual of interest, but you don't have forced to pay payments.
Yeah, I'd be. We just answered the question about, should I be cutting back because the market's coming down? Well, you just lost your job. That's kind of your own market, downturn. So, what we advise there still fits too. Go through your budget. What do you have in there that you don't really need? I always look at standard of living as an issue. So there's always something I can cut on my budget without even affecting my standard of living at all, something I'm not even using anymore, gym membership or something along those lines. But if you're laid off, you probably should be considering some reduction in standard of living, at least temporarily, just because, you don't want to compound the problems that you have by running into debt and doing all these different types of things. It's time to kind of batten down the hatchets on the budget side. That's not something we really normally recommend. We try very desperately to maintain standard of living with our clients, but a layoff is one of those, scenarios where you got to consider it as far as that goes, because you want to burn less money, less of your cash, less of your stock bonds and other things that you've got out there. Sometimes it's not possible. Got to do what you got to do, but that that you'll lessen the impact by continuing to look at how you can continue to burn less cash, right?
Yeah,
Your burn rate.
and hopefully you have some sort of emergency fund. Maybe for most working people, that can be from 6 to 12 months of kind of that's rule of thumb, that standardization of where I have 6 months, and usually a lot of times with layoffs, sometimes there's a severance package.
Yeah.
Another thing to consider is apply for unemployment. Do I qualify for unemployment? Can I get that at least benefit to subsidize some of my lost income?
Yep. Yeah, and here in Silicon Valley, one of the questions we get is, people have these restricted stock units and different things, and they'll have an option to kind of buy those out. And so been involved in a couple conversations with those. It's something to think about. It's kind of a weird scenario to put out some money to buy something when you're trying to cut back, but it really depends on the situation that you're in, whether that's worth it or not. And so there's a whole bunch of strategies there, but don't miss out on, your stock options if you have them, if you have any options with those. So it's an interesting area. The whole layoff picture is probably going to pick up here. The Federal Reserve has this dual mandate of a healthy labor market and low inflation, right? Mm-hmm. And they kept rates down, and they really, really continued to purchase $120 billion of bonds a month to create liquidity, with the concept of trying to help the labor market get back, because it was decimated. It was 15.5 million people unemployed overnight when everything closed down. And so getting that back down to 5.9 or 5.5 right now where it is a big accomplishment. But in doing that, they kept things down possibly too long, and now they're flipping over to the inflation side, and they will probably overdo it on that side. And when they do that, they'll cause more unemployment than they're expecting. Right now, their statement of economic projection that they had at their last meeting showed that unemployment would be at 4.1% versus 3.6 now. that's millions of jobs, right? That differential. And everybody that is out there, not everybody, but a lot of people that are out there are saying, well, that might be a bit low, might be closer to 5 or what have you, before you can really hammer down inflation to the 2-3% that they want. So layoffs will be more common. And so, how to deal with those, I think, is important. You're going to maybe have a 401k left over at that place of business. You need to consider what to do with that. Do you leave it there and continue to manage it? Do they allow that? Do you roll it over into an IRA? How does that work? But you have those things that you need to think about also as far as that goes. So anyway, that's a good question, and there's something, there's a lot of things that can be done. We're probably just scratching the surface really on the overall list, but it's this is a live show, we come up with these things. So, anyway, if you get into that situation, give us a call and let us talk to you about your scenario. We can run a financial plan. If you're a client, we'll redo your plan and get it up to speed and figure out what would happen, different time periods without work. And the best way to do that, where to get the money, right? Because that's important. You got to be really careful where you get the money. That's just people do wild things with, they got something over here that they should be using, and then they're taking money from this other pool, which really damages them long term. So it is important to identify where to get the money from that you're going to need to live off of, potentially too. And so good show today. Thank you so much for coming. I really appreciated everybody coming today. Had a great time. Again, you can send in questions at any time. Please do. Feel free to send them to this email address during the week. Give us a chance to think about it. You can also, to go ahead and subscribe to our channel. Go preview. We're trying to get to 1,000 videos. We'll get there shortly, which is pretty incredible. And so that is going to be, something that you can look at. You can subscribe to the channel, hit the bell button, or again, you can schedule a time to meet with us. There's a book appointment button at the top of our webpage, and you can set up a 30-minute video or phone time to sit down with Ethan and I. And we'd be happy to help you with whatever comes up, whatever questions that you might have, or whatever your situation is. Whether you're a client or not a client, we'd be happy to continue to talk to you. So look forward to seeing you next week. Thank you very much.